Hi, today I have with me Nuri, Ersahin, and Ruidi Huang, and they're both with the Cox School of Business. And we're going to be talking today about their research paper, The Impact of Competition on Startup and VC Behavior. And, thanks for taking the time to be with me today. Appreciate it. And Rudy is in China, so he's a bit concerned that he might have some internet issues. So we'll just that's the only disclaimer here. But thanks for taking the time. And so I guess we can just start. So is this the first paper that you have co-authored together, actually?
Yes, that's actually the first paper we wrote together. I think we started the project around February 2019, just before COVID.
Mm-hmm. Yeah.
And yes, and we wrote two more papers together.
Yeah. So what was the motivation for this paper?
Actually, we have another co-author here in this paper, Naveen Khanna. He has a theory paper where he investigates basically VC's motivation, different types of VCs, how they interact. Mm-hmm. And as empiricists, Ruidi and I, we thought that we can basically based on this model, we can basically look at how competition affects the VC market. Mm-hmm. And then we started doing some analysis. Mm-hmm. And we got results.
Mm-hmm. So just kind of in jumping in, and I'll kind of skip around a little bit. I mean, I'm kind of following the first several pages, but so you find that reputable VCs, projects and total investment reduces in states that offer these investment tax credit programs. Can you talk a little bit about that?
Really, feel free to talk if you want to, please. I don't want to
No, please go ahead. You'll be doing great.
Yes, feel free to pitch in, please. Yes, basically. I think identification is an important concern here in empirical papers because when you want to look at the effect of competition on VCs, there are so many moving variables, and that's why it's hard to cleanly identify the effect of competition and how it affects basically venture capitalist behavior. And basically, that's the main reason why we are looking at investor tax credit programs, mm-hmm. because we see that not every state actually introduced those programs. They are basically introduced to promote entrepreneurship and job creation, and they are given to generally smaller financial investors. Mm-hmm. And we thought that basically it's gives more incentives to younger and smaller investors. And we wanted to see how it affects reputable VCs, how it affects other VCs. And honestly, we were a bit surprised to see that reputable VCs in states with these programs reduce their investments. Mm-hmm. And yeah.
Yeah, and so what I also took away was that good VCs reduce their investments most. Ruidi, do you have a comment about that?
So this will have to tell you a bit more about the result. Actually, if I tell you why they are losing their investments, I think it's easier to explain why we find this result, right? So good VCs are being crowded out. That's basically what we say, is because they cannot compete with the younger VCs in terms of the offer, the terms, the contract they could potentially offer to entrepreneurs, because entrepreneurs want to have good terms from the VCs, and if I'm say Sequoia Capital, the best in the profession, and they probably cannot offer as much as lucrative as the contract as a new VC who is trying to establish themselves. So as a result, the older VCs or the more reputable VCs are being crowded out because they cannot, they do not want to, because their strategy in the entire VC industry, the strategy is to spray and pray. So everybody trying to invest into lots of smaller projects rather than taking on risky bets. Basically, you don't put all of your money into one project. So that's why later in the paper, we actually show that serial founders, so which means that people have established multiple enterprises or startups before, are less likely to work with those more reputable VCs, which know how to deal with VCs before, right? They are actually moving towards the younger VCs, which means that they want the better terms for them rather than having the VCs helping them.
Right. That was exactly kind of what I saw, that, yeah, they want terms, and, if they're serial founders, they already have that confidence in their activity and their choices. And I've actually met someone like who you're describing that has a big biodiversity fund. And so it's kind of interesting, just the research, the implications of it. So another thing I noticed was that, so good VCs shift investments away from states with these credits, and some of the industries connected. And I noticed that a lot of these, from what I gleaned from the paper, that a lot of these investment tax credits are geared towards the tech industry. Do either of you have any kind of color on that whole idea about good VCs, shifting away from states that are, inducing this competition, and some of the industry things you noticed in your paper?
Yes, that's one interesting result we have in the paper, but that does not necessarily mean that they are shifting away from tech. I think maybe they might be shifting from tech in that specific state and move to a different state, but keep their portfolio still within that tech industry. I think the move away is from the state.
Yeah.
And yeah, that's very interesting that that they do this. And of course, it's not that reputable VCs cannot give the money. But with this tax credit programs, you basically reduce their returns in those states. And that's why they have so many outside opportunities. And that's why they move to other opportunities in other states where they can have a higher return.
Yeah. So really, ultimately, they're chasing returns. It's interesting. I noticed, I looked at the states, and Texas was not on that list, which I found really interesting. And this is a really dynamic state for, economic activity, period. So many firms and people are moving here, and tech firms, and so it's kind of interesting about these findings right now. It's very relevant, I think, to very instructive.
Because Jennifer, sorry to interrupt you, because states only introduce those programs only when they have trouble attracting good investors, right? You see, California is not on that list,
right?
And the Massachusetts has been very recently started to offering those programs because they start to see they're slowing down in terms of capital inflows. And Texas has been booming for, in recent decades or 2 decades or so, right? There's no need for such a program to attract the tech companies to come. They just come anyway. They are going to come regardless.
Yeah, they're on to us. That's kind of cool. Because I write about that a lot. So also in your paper, you discuss in treated states, good VCs stage projects considerably more frequently. Can you just give me a little color on what that means?
Sure. I think that's a result from the second part of the paper. In the first part of the paper, we basically show that like reputable VCs in treated states reduce their investment amount. Okay, but like, do they change like their investment policy, or do they make other changes in the way they approach or like firms, or they conduct staging or syndication? Because like when it comes to VCs, investment also includes like monitoring, syndication, staging. There are different aspects of investment. That's why we wanted to open this box of investment and like analyze in more detail how syndication is affected, how staging is affected. And coming back to your point about like the staging results, we have realized that like they basically give smaller amounts and they stage more often. That's why like the time period between stages is reduced. It's an interesting result, and there are different ways to interpret this result. One way to interpret that we are more inclined to is basically returns are smaller, and that's why they want to see more frequently how the project is going.
Right. Yeah, so they want to move things along. It's a little bit of a little more impatient with results, is what it sounds like a little bit.
Yeah, you can say that. Honestly, like it's an interesting result, and we thought a lot about it, and we are open to alternative interpretations of this result too, honestly.
Yeah.
Yeah, in layman's terms, this result would be interpreted as so the VCs wants to keep the portfolio companies on the tighter leash.
Yeah.
So basically, they want to keep an eye on them to make sure that they behave. Right.
And that's the case more in states offering these investment tax credits. In other words, if you're going to have these tax credits, kind of influencing, then there's going to be more pressure in some respects for performance, and showing some results and that sort of thing. So kind of, if you had to describe a penultimate result with your findings, with the effect on VCs in these tax credit states, what would that be to each of you, actually? Sort of the finding that was the most interesting, or you thought was the most, meaningful. Nuri, you can start.
I think it crowds out reputable VCs, and I think that's a very interesting finding.
Ruidi,
to me, what's more interesting, something that we're working in progress right now, is something we're trying to look at the data, because the more reputable VCs, they're big VCs, they're diversified. And we're actually working in progress trying to see whether it's actually a bad thing for the reputable VCs to be diversified. Because if they are diversified, they can easily back away. Instead of me, see, I'm a very young VC, I just have to stick my neck out of there and fight for this. Then that will speak to whether diversification is a good thing or bad thing from the VC perspective, which is actually hopefully gonna be another highlight of our paper. Hopefully you have the results soon. That's something we're working on right now.
Well, and also something in the paper you discuss how, this is, VC investment is a local issue, right? I mean, there's more local concentration, there's geographic concentration. And so it sounds like that's what you're relating it to a little bit.
Yes. So for most VCs, right, they start very small and they just in one area, normally in Menlo Park, California. That's where normally most of them start, and they start to grow out, or in Austin, Texas, they start to grow out. And once they get bigger, they expand their footprints into other states. But yeah, that's how the life cycle VC mostly look like, right? But for them, if they get too big, it's easier for them to retreat when there's more competition in certain places instead of just to go head on head to compete with their competitors. So that's something hopefully we can add to the paper, hopefully soon.
Just a question I have, I mean, just as a curious question, what's the difference between like VC type firms versus PE type firms, private equity? I mean, how would you characterize the difference in those two, just for me in terms of framing even?
I can't give you my answer. I mean, if you ask 10 different people, there are 10 different answers, I think. So VC is probably a subset of private equity. It's not a private equity fund, if you would think of that way. So private equity funds can invest into VCs. They can buy or whatever you want to buy, right? Anything you can imagine these days. But for VCs, they're very specific, right? They're what we call the venture capitalists. So they actually invest in startup companies only.
Right.
That's what they do. So they go issue private debt to companies. That's what PE firms do. They did a lot, but VC firms don't do that. They only take equity stakes in private companies, in startup companies.
Yeah. Okay. Thanks for that clarification. Also, let's see. Okay, so can you also, well, one takeaway, just from what we were discussing about, the findings, and that most reputable VCs, the reputable VCs are affected most, you found in your paper. And it sounds like on a big picture, 30,000 foot level, that this easier money destroys value, in a way. Can either of you talk about that a little bit?
Definitely. So people can ask the following question. Okay, reputable VCs reduce their investments, so what? Somebody else will basically do that investment, right? But reputable VCs are reputable for a reason. And they bring a lot to the table, especially in an industry where relationships matter, like monitoring, advice, professionalization. It's not only about the quality of the money that comes is very important. It's not only about the amount of money that comes to the table. When it comes to managing startups, managing innovation, the quality of the money also. That's why there's always this question of dumb money, smart money, what type of money is coming there.
Yeah.
So that's why the fact that reputable VCs reduce their investment also means that they withdraw their expertise and all professional things they share with startups. And that's why the last part of the paper, we also show that actually that's a result about the reputable VCs. Their investment success in these states goes down. But we think that it's not good for the states that reputable VCs reduce their investments.
Right. Ruidi, did you want to add anything?
Just to Nuri's last point, yes, for the states, if they're losing the reputable VCs, for the long term, it's bad for them, especially, right? The reputable VCs, there's a reason they are good VCs, because they can put companies go through the IPO process. That's where most of the Facebook or Apples of the world today are invested by very, very reputable VCs back in the day. So the big word we normally try to avoid to use is the welfare impact. For the other firms in the state might not be as good as the government intended to have those programs in place, because they're actually basically chasing some talent from the reputable VCs away from their state.
Yeah, and that's really an important thing for this, innovation economy drive, right? I mean, you could be in fact driving out innovation, via these tax credits, if you're not mindful in how you maybe structure them and, all that, and market them and who you attract and how. And, this comes to mind. I don't know if either of you are familiar with the Inflation Reduction Act. It's obviously, I write about energy and the energy transition a lot, and it's obviously sparking a lot of activity. And, there's a lot of tax credits, and a lot of them are uncapped. And so the idea of this smart money versus dumb money, I'm sensing there's a lot of dumb money happening with this, which is scary because ultimately it's the taxpayer that's going to take the hit, and yes, there's going to be some, there are going to be some innovations for sure, but it's just, throwing a bunch of darts in some respect. Are either of you have you been following that a little bit? And it seems like your paper has implications for this, even federally, right? Any comments?
Well, every policy has its pros and cons, right? And I think any policy is better than no policy. That's always my opinion on any policy. And maybe they cannot get everybody, but a small group of people will benefit, and there will be inefficiency as always,
Right.
which are expected. And is the only thing I think the government can do better, just make better policy, make more informed decisions. Hopefully our research can help.
Yeah. In other words, they can learn by doing, because, right. I mean, that, I guess maybe that's a really big message of your paper is, to reevaluate what your policies are and what it's doing, and then, kind of reset them or adjust them or whatever. So do you have any, just kind of one other quick question before we conclude? So you note that there's a link between capital inflows and a reduction in productivity that crowds out, this skill potentially. And so is there another way to see this, aside from it just being it's a kind of a negative for the innovation economy, right? But I mean, what's your color on that idea?
Actually, our paper also shows evidence consistent with that, where we think that there's a lot of skill coming from reputable VCs. Another thing, actually, one thing I would like to add to the previous policy conversation too. It will look like I'm advertising somebody else's book, but Josh Lerner has a book on these policies and VCs all around the world. The book's name is Boulevard of Broken Dreams. And basically there's not a uniform policy that will be successful everywhere. Sometimes one country has a very successful policy, and basically other countries say, okay, let's apply this policy. However, they cannot get the same success that they got from that the other country also had. So when it comes to policy, sometimes it's really hard to predict what will happen. So that's why it's a very, very tricky. It's a very, very tricky area. And there are instances where you have very good intentions, but you can crowd out skill. So that's something we report in the paper.
Ruidi, did you want to add anything on that? Or and my final question is just, any final thoughts on your research and findings, and then what we were just talking about. I'll go to you, Ruidi, and then turn it to you, Nuri, last.
So I just want to say, we have been saying this quite a few times during our conversation today, is I mean, for any policy, it's just the trial and error, right? You just have to try it and see how. There's so many unintended consequences. I'm sure all the governments, the local state government, have the policy in place. No ill intended. It's all wanting to attract more talent and capital to their states, but they might not go the way they wanted because nobody can predict how people react to incentives. So it's on that point, I think just, maybe government could reach out to economists and work with us to see whether we can help them to have better policy design. Because many governments do hire people who do research to help them to make a more informed policy, right?
Yeah, because in the end, you don't want to waste money, right? You don't want to waste capital, time, people, because that's costly. So Nuri, do you have any final concluding thoughts about this work or anything that we've discussed that you want to wrap up?
Sure. I think I think we have to question everything that seems so obvious. Like in the example of this credit programs too, you can say we're going to increase the competition. So competition is good. More money will come, more investors are going to come, and in a more competitive competition is always better, right? However, who are you giving the money? What kind of competition are you creating? What do you mean by competition? I think as economists, we have to question everything here, every notion that seems so obvious, that can be taken as granted. And what we see here is something that looks like increases the competition here. Increasing the competition here actually doesn't have very good consequences at the end.
Right. Yeah, it sort of becomes like the wild, wild west of competition, unhinged. Yeah, and you have to be more thoughtful about it. Yeah. Well, thank you both for your time. And it's a really cool paper, and I'm going to enjoy writing it up too.
For having us.
Thank you for